Hello and welcome. Good morning. You're watching Market Cafe on ET Now with me, Sneha. As always, with me is Shreyansi Singh this morning. Shreyansi, good morning. And well, this is a show where we're going to take you through everything that happened in India as well as overseas post-market hours yesterday, bring you all the action from Wall Street and Asian markets. And in the second half of the show, we'll get stock-specific talk about all the stocks that could be potential buzzers in today's trading session and also the ones that brokerages are flagging off for us bright and early this morning. On that note, then, let's kickstart the show then. And Shreyansi, take us through what the US handover looks like.
Well, absolutely. Good morning, Snehi. And then when you take a look at stock futures, what you're really looking at is that there's not much happening on that front though. So S&P 500 futures, a gain of about 0.5% coming in there. Nasdaq 100 futures as well jumped nearly 0.9%. And when you take a look at Dow Jones futures, there also you see a 0.1% gain coming in as well. Now, in terms of what else happened in trade, now of course we'll be taking you through this in greater detail. But then in extended trading, you did have Meta Platforms that rallied 7% on stronger than expected second quarter results as well as upbeat guidance. So that's something that gave a little bit of enthusiasm, that upbeat set of earnings for Meta. Stocks are also coming off a winning session that saw the S&P 500 rally about 1.6% for its best day since February as well. And when you take a look at the Nasdaq, then you're looking at gains of 2.6% coming in there as well. When you take a look at Dow as well, you're looking at 0.2% increase coming in there as well. And those gains come as Fed Chair Jerome Powell signaled that the central bank could cut at its next meeting if the data continues supporting the narrative that inflation is rising. So that is something that the market is keeping a very close eye on. Other than that, you did have mega cap technology and semiconductor stocks that really bounced back yesterday. And when you take a look at Nvidia, you do have that surge coming in of nearly 13% for tech darling Nvidia. So that was on the heels of a strong quarter from advanced micro devices as well. And despite Wednesday's rally in technology shares though, you do have the Nasdaq finishing July with a 0.8% loss. The S&P 500 added just about 1.1%. And the Dow was the real outperformer here out of the three major averages with a 4.4% gain coming in and its best month since December. So it was still a good July for the Dow. Can't say the same about Nasdaq or S&P 500. And the Russell 2000, a beneficiary of investors' rotation into small cap stocks as well, advanced 10% in July. So a good July coming in for that one as well. Now the busy earnings week of course continues, and you've got key reports from Apple and Amazon after the bell. You do have Intel, Booking Holdings as well as Moderna that are also on the deck. So keep an eye on all of those earning sets. And also on the economic front, investors are also awaiting jobless claims data. So that would be key to watch out for. Construction spending for June as well as ISM manufacturing data for July as well. And the main event for the remainder of the week, of course, is going to be Friday's keynote July jobs report. So keep an eye on that as well. That largely is the kind of handover that we're getting this morning from Wall Street. A winning session, and that is what we're coming off at this point, but then not much of a good July except for Dow as well as the Russell 2000. Let's quickly take a look at what the European indices did then. When you take a look at European markets, closed higher on Wednesday, maintaining that positive momentum really. When you take a look at Stock 600, you're looking at an 0.8% gain coming in there as well. And when you take a look at DAX, you're looking at 0.5% gain there as well. So that largely is the handover coming in from Europe as well, Sneha.
Absolutely, and before we take a look at what the oil markets have been up to, just want to draw your attention to what the implied open is indicating. Above 25,000, in fact 25,110, so above 25,100 for the first time ever is where the implied open is. 100% uptick is what it's showing. It should be a 100-point uptick, and well, it's a 160-point uptick at least coming in on the spot basis. So we'll just see what's the trading session looking like today, because like Shreyansi mentioned, a very strong handover coming in from the US. But on that note, let's take a look at also what oil and crude were up to then yesterday. Oil prices rose in early Asian trading on Thursday, extending strong gains in the previous session after the killing of a Hamas leader in Iran raised the threat of a wider Middle East conflict and on signs of strong oil demand in the US. Now, let's also take a look at what these individual indices have done yesterday. You had WTI at 78.57, actually slipped below that $80 per barrel that it was holding on to, and 78 80.5 is where WTI is as of now, almost 0.9% higher in trade. You also have Brent, that's unchanged as of now, 80.72. But yesterday, remember, when the news came in that Israel has struck the Hamas chief, that's when we actually saw a very big uptick coming in oil, a sharp spike coming in. But as of now, both of these indices looking settled. However, WTI inching towards a 1% gain on that front as well. Let's understand what's leading to all of this. The most active contracts on both of these benchmarks jumped about 4% in the previous session. But what's key to note is also that Hamas leader Ismail Haniyeh was assassinated in the Iranian capital Tehran yesterday, less than 24 hours after Lebanon-based Hezbollah's most senior military commander was killed in an Israel strike in the capital. Now, the killings fueled concern that the 10-month-old war in Gaza between Israel and Hamas was turning into a wider Middle East war, which could potentially lead to disruptions in oil supply from the region. So that's one of the reasons why oil prices were slightly pushed up higher, because supply seems to be tainted as of now, demand remaining unchanged. That's how price mechanism would work and would push the price of oil higher. Now, also pushing up oil prices was a set of data releases from the US, the world's top oil consumer, and a weaker dollar as well. Lots of factors actually coming into play when we take a look at what's been boosting oil. You also had robust export demand that pushed US crude oil stockpiles lower by 3.4 million barrels in the week that ended 26 July to 433 million barrels. This is the data from the US EIA coming in, and this is what the data showed yesterday. US oil stocks have declined for 5 consecutive weeks now, the longest such streak since January 2021. US oil demand was at a seasonal record in May as gasoline consumption surged to its highest since before the pandemic, and a separate data release from the EIA showed this on Wednesday as well. Meanwhile, the US dollar index extended losses on Thursday from the previous session after the Fed Reserve held interest rates steady but left the door open for a rate cut in September. We'll also be talking about this in detail later in the show. And a weaker dollar can boost oil demand from investors holding other currencies, yet again making oil a little bit more attractive, driving prices up. So lots of factors when you're watching out for WTI and Brent crude prices. But well, that's largely what was taking place on the oil front. Quickly, let's jump over and see what gold is doing. Gold above $2,500 per ounce as of now, 1.15% higher is where gold is after Fed's Powell hints at an early rate cut as well, in line with what the street was expecting, which is why you've seen equities in the US, in Europe, oil doing pretty well, gold doing pretty well, not much to complain about, and that's also reflecting on our implied open. Positive handover coming in on all fronts, Shansi.
Well, absolutely not much to complain about, but let's take a quick look at what events you should be watching out for. From India, you do have manufacturing PMI as well as weekly Nifty expiry. From the US, we've largely covered the cues that we should be looking out for. It's the initial jobless claims data that you should be keeping an eye on. And from the UK, you do have manufacturing PMI as well as Bank of England's rate decision. So keep an eye on that. And from the Eurozone, then manufacturing PMI as well as unemployment data. And from China, then kicks in manufacturing PMI will be the one to watch out for. In terms of global earnings, like I mentioned, Amazon and Apple are going to be reporting their numbers, so they would remain in focus. In Q1 earnings, then you do have Tata Motors, Sun Pharma, ITC as well as Adani Ports in focus today on account of their earnings. In terms of corporate action, you do have HDFC Bank that is revising credit card rules. There's Navneet Education share buyback as well. That stock will remain in focus, along with Power Grid Infrastructure Investment Trust income distribution is the one to watch out for. So that one will remain in focus. And lastly, to buy shares of CAMS as well as Weber Global, Tips Industries as well as GE Shipping and Oberoi Realty to be eligible for dividends. So all of those counters will remain in the spotlight also. In terms of other things to watch out for, in terms of primary market action, you do have Akim's Drugs and Pharmaceuticals IPO that is closing today. Ola Electric's IPO's anchor book opens, and First Cry will be announcing IPO price band as well. So all of those will remain in focus. And in terms of other events, then there's new FASTag rules that are set to kick in, so keep an eye on that as well. And NCLT will be hearing final hearing on Disney Star India Reliance's Viacom 18 merger as well. Other than that, there's Bank of England Governor Andrew Bailey who's set to speak, so that speech will also remain in focus.
Absolutely, and let's take a look at all the important events. The biggest important event, in fact, is the FOMC announcement that came in. Before we go to that, let's quickly also take a look at what the US Treasury yield is doing, because remember, when the market sentiment is strong, reflects well for equities, reflecting well for oil, for gold, but there is one index that actually slips when the market sentiment is positive, and that is the bond yield. Now, as of now, US Treasury yield has fallen nearly 5 bips to 4.044%. 2-year Treasury yield is also down 4 bips. Remember, yields and prices have an inverted relationship, and so on the back of that, when all the sentiment is positive, you have yields that are inching down slowly, some softening seen on that front. But let's begin our coverage this morning with the biggest cue for the markets, the comments from the Fed Reserve Chairman Jerome Powell. While the central bank has kept its key lending rate unchanged at 5.25 to 5.5%, Chairman Jerome Powell said a rate cut in September is on the table, even as the FOMC members cited further progress towards that 2% inflation target. But the Fed chief also cautioned against assuming that a cut was definitely happening. So some positive indication there, but nothing for sure coming on that front. Forecast for the September rate cut, he said, was based on the assumption that the US economy follows its expected path. Let's go across and hear out what Fed Chair had to say and what has actually buoyed the market momentum as of now. Let's listen in.
On September, let me say this. We have made no decisions about future meetings, and that includes the September meeting. The broad sense of the committee is that the economy is moving closer to the point at which it will be appropriate to reduce our policy rate. In that, we will be data dependent, but not data point dependent. So it will not be a question of responding specifically to one or two data releases. The question will be whether the totality of the data, the evolving outlook, and the balance of risks are consistent with rising confidence on inflation and maintaining a solid labor market. If that test is met, a reduction in our policy rate could be on the table as soon as the next meeting in September.
Well, there you have it. So that's the word coming in from Jerome Powell. But let's move on and take a look at Meta Platforms that delivered a better than expected second quarter result on both top and bottom lines. The Facebook parent also issued a sanguine outlook on revenue while lifting the lower range of its annual capital spending outlook. However, the total expense guidance for the full year remained unchanged in a range of $96 billion to $99 billion.
Keep it going with earnings then. Qualcomm delivered a beat in their fiscal third quarter results, particularly on account of sales in the quarter gone by. The company also provided strong guidance for the ongoing quarter. Qualcomm said it expected between $9.5 billion and $10.3 billion in sales in the current quarter compared to street expectations of $9.71 billion. The company's biggest and most important business is in making processors and modems for smartphones, which was up 12% year on year.
Alright, on to some more news and updates then. Amid signs of renewed efforts by both India and China to resolve the military standoff in eastern Ladakh, both countries held another round of diplomatic talks. Both sides have now agreed to maintain momentum through established diplomatic as well as military channels. India and China have agreed on the need to jointly uphold peace and tranquility on the ground in the border areas in accordance with the bilateral agreements as well as protocols reached between these two governments.
Well, that's happening globally, but that's a wrap on our global coverage this morning. On that note, we'll slip into a short breather on this edition of Market Cafe. When we return, we'll take a look at how the Asian markets are doing, if they're actually in tandem with the global handover. So stay tuned, we'll be right back. Hello and welcome. You're still watching Market Cafe on ET now. Let's take a look at the Asian markets because Asian markets have largely risen today after comments from US Fed Reserve Chair Jerome Powell indicated that a rate cut could be happening in September. Outlook remains encouraging. However, let's talk about Japan's Nikkei. It's the notable outlier today, tumbling more than 3.3%. There you have it, a more than 1,200 point or 1,300 point cut coming in on Nikkei this morning. Broad-based topics also down 2.5%. Yesterday, the Bank of Japan raised its benchmark interest rate to around 0.25%, marking its highest level since 2008. The yen has fallen below that 150 level against the dollar late yesterday, currently trading at 149.7. The country's finance ministry revealed that it spent 5.53 trillion yen on foreign exchange intervention as well. So Nikkei largely under pressure. On the flip side, let's talk about Australia's ASX 200. That touched an all-time high, gaining almost 0.5% at open. As of now, also trading right there. Investors in Asia will also assess business activity data from around the region with the PMI or Purchasing Managers Index due from China, Japan, South Korea as well. On that note, South Korea's Kospi climbed almost 0.5% as open, but seems to have fizzled out all of those gains this morning because as of now just 0.2% higher. Reuters reported that the country's exports rose at a faster pace in 6 months in July, according to the preliminary data. Shifting focus quickly, let's talk about what Hang Seng and Shanghai are also up to this morning, and Hang Seng also looking slightly under pressure this morning, 0.3% cut coming in on that index. Quickly, let's pull up Shanghai. Shanghai also rather flat, not much happening in fact when it comes to Shanghai, but all eyes need to be on that implied open this morning because we shut shop at 24,951. However, remember, futures already tilted over 25,000 yesterday, and 25,100 indicated on the spot basis, more than a 150 point uptick coming in for us this morning. Handover looking solid, Nikkei looking like the only pressure point from the global handover, but well, yes, all looking good for the Indian markets today.
Well, absolutely. It's looking all good for the Indian markets, but let's keep it going and let's take a look at the power pack lineup for you that we have on the market. At 8:35, we'd be in conversation with Kalishwar Arunachalam, CFO at Crompton. At 9:30, then Shrikant Gopalakrishnan, CFO at 5-Star Business Finance, will be talking to us about their earnings. 9:40, then Rajesh Jujurkar, EDN CEO Auto and Farm Sector M&M, will be talking to us about their earnings. And at 9:50, then Ashu Singhal, MD Mahanagar Gas, will be talking to us about Mahanagar Gas's earnings. A host of earnings related conversations from Rahul Mittal, CMD Rights at 10 a.m. to 10:15, Debadatta Chand, CEO and MD at Bank of Baroda. At 10:20, then Mr. Bidkar Sudhir, CFO at JK Lakshmi Cement, will be talking to us about their earnings. And Madhavan Menon, Executive Chairman Thomas Cook India, will also be talking to us at 10:30 about their earnings. Lastly, we also have Nishant Arya, VC and MD, JBM Auto, to talk to us about their earnings at 10:40 a.m. So keep an eye on all of those interesting conversations.
Well, yes, lots to talk about in terms of management earnings and the outlook for all of these companies. Interesting conversations lined up today on ET Now, but on that note, hi there, welcome back. Still watching Market Cafe on ET Now. Let's talk about some major earnings yesterday. Then Tata Steel reported a mixed set of results in the first quarter. Revenue came in lower than expectations. Meanwhile, profit for the quarter managed to meet street estimates. On the other hand, you had EBITDA and margins that came higher than what the street was expecting. My colleague Ashesha, who tracks the sector closely, is joining us with all of those earning highlights. Ashesha, good morning.
Well, absolutely. It's a mixed bag that has come in for Tata Steel this time around. Revenues have come in below what the street was working with. But as far as margins are concerned, margins are above what ET Now poll was suggested. And even on a sequential basis, margins look pretty good. As far as volumes are concerned, remember India volumes were on the lower side this quarter, especially after a seasonally strong fourth quarter that the company reported. In fact, adjusted EBITDA per ton for India operations has come in at 13,661 rupees per ton, which is a decline of about 9% on a sequential basis. Remember, steel HRC prices were also largely steady on a sequential basis. As far as European operations are concerned, remember it has been reporting losses for the last several quarters, and now European losses have finally narrowed. So in the quarter gone by, losses have come in at $27 per ton versus $37 per ton loss that the company had reported in the previous quarter. So yes, largely it looks like a mixed bag. Revenues are below what the street was working with, but EBITDA and margins have come in above, and European losses have narrowed, and that is a positive this time around.
Alright, thanks Ashesha for that update. So mixed bag coming in for Tata Steel there, but let's move on. Take a look at Maruti Suzuki that reported a solid set of results for the first quarter. When you take a look at revenue, profit and margin came in above the street expectations, helping the stock eke out gains in the last hour of trade, last few minutes also. And profit rose by over 45% compared to the last year. Meanwhile, when you take a look at margin, that expanded to 12.6% versus 9.2% in the same period last year. So a beat on all fronts coming in for Maruti Suzuki. Let's also take a look at what the brokerages had to say then, Snehi.
Absolutely, and a word coming in from Investec this morning on Maruti Suzuki. They've maintained a hold rating, but they've hiked the target price to 13,260 from 13,000 earlier. So that 260 rupees price hike for the stock is what they're penciling in. Operational beat driven by margins is what they're saying. There's also some moderation in industry growth, but that has been led by a higher base, and the company has also flagged industry moderating to 5% growth as well. Now, Hyundai listing is what Investec believes would offer a pure PV play, so that should be something to watch out for. But well, on the other hand, they've retained their hold rating, target hike to 13,260 compared to 13,000 earlier. But Shreyansi, M&M also, an auto major, Nifty major, came out with its earnings during peak market hours yesterday. Tell us what the brokerages are making of that as well.
Well, absolutely. So when you take a look at what Investec had to say, they have a buy rating on the counter that they're maintaining, and they've also hiked the target price to 3,220 from 3,100. They're talking about how there's strong growth momentum that they also see continuing, and in terms of other things, they're also talking about how the operational beat as well as earnings upgrades is likely to continue. So that's the kind of growth roadmap that they see for M&M. In terms of other things, they're talking about how M&M's valuations are going to be supportive, led by EBITDA CAGR of 20%, EPS upgrade cycle, as well as EV preparedness and strong ROICs as well. So that is the kind of word that we have coming in from Investec on M&M.
Absolutely, and let's shift focus away from brokerages and stock-specific news. Let's talk about some action coming in now. The Supreme Court today, in fact yesterday, reserved its orders on the issue of state taxation of mine operators being given a prospective or retrospective effect. While the central government has argued in the apex court against allowing states to recover past dues, some states like Jharkhand and Uttar Pradesh have argued in its favor. We also have some news flow coming in on Orissa this morning on the same news flow, but as of now, ET Now's Aishwarya Patil filed this report earlier. Let's go across and listen into all of these details.
Well, another crucial hearing was held at the Supreme Court today on whether its 25th July judgment, which gave and upheld the power of states to tax mineral-bearing lands as well as mineral rights, whether that should be given only a prospective effect or a retrospective effect. As far as today's hearing is concerned, it was headed by a 9-judge bench, of course led by CJI D.Y. Chandrachud. What the bench heard during the arguments was that whether the state should be allowed to recover dues passed based on the 25th July judgment either before or after the judgment was passed, and that was the bone of contention as far as the hearing goes. Now, the 25th July judgment, as you remember, was held by a 8-to-1 majority that states have the power to levy tax on mineral rights, and that the Union Law, Mines and Minerals Development as well as Regulations Act 1957 do not limit such power of the states. CJI D.Y. Chandrachud wrote the judgment on behalf of himself as well as 7 other colleagues, and Justice B.V. Nagaratna delivered a dissenting judgment on that particular verdict day as well. Now, the highlights of the hearing that took place today includes and of course says that the final judgment on this particular case, whether retrospective or prospective, will have some financial implications in some cases, and in the case of certain companies could even have taxes that could turn out to be higher than even their net worth. Solicitor General of India, Senior Advocate Harish Salve, and few other advocates representing the states as well as some companies, including the likes of Mahanadi Coalfields, India Cement Limited, Kesoram Industries, Hindalco, Kanoria, and few other states, including UP, Rajasthan, did give their arguments during the hearing that took place today. So we'll see how this whole judgment and the final hearing that takes place going forward will sort of turn out, and does that augur well for any of these mining companies going forward. Back to you.
All right, thanks Aishwarya for that update coming in. Moving on then, it's tomato prices that have really shot up, and we caught up with Consumer Affairs Secretary on the price rise of tomatoes, onions, potatoes as well as other essential commodities. Listen into what she had to say about the declining trend that is seen in the prices across the country now, and also she shared her rationale for the same. So listen into a slice of this exclusive conversation then.
Potato, tomatoes and onions. We are very happy that to see a constant decline in prices which are prevailing nationwide. We do collect every day prices from 550 centers from across the country, and these are the prices which are taken from the wholesale markets as well as retail markets. So now we can see a decline in all the major 5 pulses and also in potato, tomato and onions.
So this declining trend that you're suggesting is in range of like 15-20%, 10-15%, what overall?
So overall, in the wholesale mandi, there has been a decline of 4%, which is very, very significant. And we are now seeing the same trend in the retail market also. Now, with regards to tomato, which had suddenly the prices went up, and we immediately took decision to sell tomato at 60 rupees. Today we have started selling it in Mumbai also. With this intervention of NCCF selling tomatoes at 60 rupees per kg, this has brought down the prices and the prices have cooled off.
And do you understand that, do you analyze that this trend is likely to continue based on what factors?
This will continue because of very good rains, and as we had always said that this year we are going to have a very good rainfall.
All right, let's shift away from that. Talk about a counter of stocks, in fact, a basket of stocks that was buzzing away in yesterday's trade, and that's the entire insurance sector. This was on the back of comments coming in from Union Cabinet Minister Nitin Gadkari, who has urged the Finance Minister to withdraw the goods and service tax, the GST, on premiums paid for life and medical insurance, a move that could reduce the burden on insurers and would likely also boost product demand for the sector overall. Let's go across to Anurag Shah with more details on this. Anurag, take it away.
So demand for reduction of GST on insurance premium has again picked up, and this time Cabinet Minister Nitin Gadkari has returned to Finance Minister Nirmala Sitharaman saying that 18% GST on life insurance, which is term insurance and health insurance, is unfair because it's a protection against the uncertainty, the term insurance, and for life insurance, medical insurance, it's hindering the growth of sector also. Industry bodies also from very long asking for the reduction on GST on health insurance, and couple of times insurance industry has returned to Finance Ministry that they are ready to pass on if there is any reduction also in GST, because presently the 18% GST is hindering insurance industry a lot, especially on the health side, and for public at large also, especially the senior citizens are suffering a lot because of 18%. If we talk about the data also, so in FY20, overall premium underwritten by general insurer and health insurer was of around 56,000 crore. And in FY24, it has doubled around 1,09,000 crore. So in that same ratio, GST share has also increased from 10,000 crore to around 19,621 crore. But number of policies and number of life covered has not increased in this fold. A number of policies and number of life covered has increased by just 11 to 12%, which is impacting the growth of insurance sector. Presently, the general insurance penetration is only 1% of GDP against the global average of 4%. So that is also hindering the 18% GST is hindering the growth of the overall industry also.
All right, thanks Anurag for joining us bright and early this morning. On to an exclusive conversation then. My colleague Sumit Chaturvedi spoke to TCI's MD Vineet Agarwal about the Red Sea crisis as well as container shortage issues, and he had to say that Red Sea crisis is impacting the company indirectly. Listen into what else he had to say in a slice of this exclusive conversation.
The container shortage is on and off. Actually, what happens is container shortages get created because when containers go to a particular location, they have to come back as well. It might be coming back empty or it might be coming back full. Some of those routes or the lanes have gotten disrupted. Because if you were going through the Red Sea, you would take less time to get to a particular destination. But now if you're going all through Africa, that means the time taking is more, which means that the containers that have to come back are also taking longer time. Hence, this repositioning time is actually leading to some shortage of containers. Again, in a few weeks, this should get resolved as the market equilibrium gets maintained again.
And if we talk about TCI, the freight rates, and if you can talk about a bit of your expansion plans, what are the expansion plans and how are they currently going on?
As a company for fiscal year 25, we are looking at a 375 crore expansion. We are spending about 75 crores in paying advances for buying 2 new ships, which we've just placed the order. These ships are of 7,300 deadweight tons each, and the total cost is about $38.8 million, and they will be delivered in 2026. We're also investing about 100 crores in new warehouses, buildings, and land, as well as about 75 crores in trucks, etc. And the rest about 75 odd crores in warehouses, warehousing equipment and containers and so on. So that's a 375 crore budget, and next 4 years we intend to spend about 1,000 crores.
And freight rates, if we talk about that, do you see them moving up currently from these levels, or how do you see them?
Domestic freight rates are a function of fuel and of demand and supply. So we don't expect that to move up too much. International freight rates, we think it should start moderating.
Alright, on that note, we'll slip into a very short break on this edition of Market Cafe. We'll get more stock specific and talk about all the potential buzzers in today's trade when we return on the other side of this break. So you stay tuned. Hi there, welcome back. Still watching Market Cafe. It's the first day of the month. That means all eyes will be on Motown as July auto sales numbers will start trickling in. And volume growth is expected to be healthy across segments as we gear up for the upcoming festive season. Shrishti joins us to tell us what to expect across the auto set this time. Shrishti.
Well, for July auto sales estimates, we are estimating that the two-wheeler segment could be the outperformer in the month gone by. Apart from that, the other segments are also expected to post a healthy set. Why we are expecting that the two-wheeler could have the biggest push amongst the other segment is because of the rural as well as urban demand is expected to support, and for the upcoming marriage season, some of the pre-buying has also started. If we talk about the numbers, then firstly, for M&M Automotive Division, we are expecting a jump of just 3% on a month-on-month basis, while for even Tata Motors passenger vehicle as well as Maruti Suzuki, we are expecting a single-digit growth. So that's about the passenger vehicle segment. Not much is expected on this particular segment, but definitely the momentum should continue as per what we are expecting at least. If we talk about the two-wheeler segment, then this could actually show a double-digit growth for select companies when we compare the number on a YOY basis. Bajaj Auto and Hero MotoCorp are some of the companies where we are expecting 11 to 13% growth on a YOY basis, while for TVS as well as Eicher Motors Royal Enfield, we are expecting a single-digit growth, but the growth should be is expected to be seen on the positive side. When it comes to the commercial vehicle segment, then do watch out for Eicher Motors VECV because on a low base, 17% YOY growth is what we are expecting, while for Tata Motors CV as well as Ashok Leyland, the numbers could be just flattish, but the good point is that the growth could be supported by the replacement segment. And lastly, if we talk about the tractor division, definitely a segment which has a lot of cycles involved, but for this time we are expecting 26,050 units for M&M tractor division as well as for Escorts 5,650 units is what we are expecting, and the normal monsoon is expected to support the volume. So all in all, a good set of numbers expected from July auto sales estimate. Back to you.
All right, thanks Srishti for that update coming in. So that's the update coming in terms of what is being penciled in when it comes to Motown. As we move into a new month, then let's take stock of how the market has fared in August. Over the last 10 years, indices, stocks and sectors, a comprehensive analysis coming in then. Let's take it across to my colleague Ashesha, who will put all of these things into perspective. Ashesha?
Yes, first up, let's talk about the index performance, where Nifty has given an average return of about 1.1% over the last 10 years and closed in the green in 6 out of the last 10 years. Meanwhile, Nifty Mid Cap Index has given an average return of about 2.4% and closed in the green in 7 out of the last 10 years. Let's also talk about individual sectoral performance then, and in the top 5 best performing sectors of the last 10 years, at the top of that list, we have Nifty IT Index, which has given an average return of about 2.4%, followed by Nifty Auto with an average return of 2.1%. We have Nifty Pharma, Nifty FMCG and Nifty Private Bank Index, which have given an average return of 1.4 to 2% over the last 10 years. Let's also talk about the only two sectoral indices which have given negative returns. It includes a Nifty Real Estate Index, which has given a negative return of 1.9%, and Nifty PSU Banking Index, which has given a negative return of 0.8%. Remember, these are the only two sectoral indices which have given an average negative return over the last 10 years. Nifty Realty is also that index which closed in the red on 7 out of the last 10 occasions, and Nifty FMCG and Nifty Energy closed in the green in last 7 out of the last 10 occasions. Meanwhile, let's also talk about some individual stock movers from the futures and options space, and stocks which closed in the green on 9 or more occasions include Trent with an average return of 10%, followed by IRCTC, Polycab, LTTS and SRF, which have given an average return of 7.6 to 8.8%. Let's also talk about the losers then. Stocks which closed in the red in 7 or more occasions includes Balrampur Chini, which is given an average return of negative 4.3%, followed by Motherson Sumi and MCX, which have given negative returns of about 2 to 3%.
All right, Rishita, thanks so much for compiling all of that interesting data for us. Let's shift focus, talk about yet another earnings candidate, and that is Z Entertainment. Now, the stock saw an uptick of 2.5% yesterday post the numbers. Rather mixed or to an extent inline set of numbers coming in from Z Entertainment. Let's see what the brokerages are making out of these Q1 numbers. First up, let's talk about what Citi is making of Z Entertainment. They've maintained a sell rating with a target price of 137 rupees per share. They say that the Q1 was mixed. Margin expansion looks to be on track, but growth challenge continues to remain for Z Entertainment. They will monitor any material increase in ad revenue coming in and the extent of that benefit that will trickle down to the stock as well. They remain concerned on the potential impact of the cost saving measures that Z has recently undertaken. So sell rating coming in with a target price of 137 from Citi. Moving on, let's also take a look at what Bank of America had to say on Z Entertainment. They've maintained an underperform rating, but on the flip side, some positive news coming in on this front, because they've hiked the target price to 134 rupees from 132, a 2 rupee hike coming in. But this could mean good news for Z Entertainment as well. They say that revenues were in line, but cost control levers lead to a margin uptick this time around. They expect to see some recovery in the second half of FY25. The FCCB raise in the tranches over long term is something that could pan out well for the stock, but they also maintain their underperform rating as they see risk reward as unfavorable for the time being. So maintained an underperform rating with the target hike coming in to 134 rupees per share.
Well, absolutely. And on that note, let's also listen in to Puneet Goenka, MD and CEO at Z Entertainment, and listen to what he had to say then about the financial year 25 margins as well as the growth roadmap that he's really penciling in.
Compared to the previous quarter, our margins continue to display considerable improvement sequentially, and we aim to drive this positive momentum higher as we move forward into this fiscal. Our conversations with large FMCG clients indicate the pickup in advertising spends in the second half of the fiscal and with the onset of the festive season. ZEE5 remains well positioned in the digital landscape and has seen healthy quarter-on-quarter growth in usage and engagement metrics, underscoring its strong fundamentals. With the platform's strategic focus on good quality content, language markets, targeted investments, and in exciting content lineup, we expect ZEE5 growth momentum to sustain.
All right, so slightly positive commentary coming in from the management at Z Entertainment, but with that, let's keep it going with all the earnings. Let's shift focus to the Nifty earnings today, and one of them is Tata Motors. It's all set to come out with Q1 earnings. Net profit is expected to jump nearly 77% on a year-on-year basis. Shrishti is here with all the expectations that the street is penciling in when it comes to this auto major. Shrishti.
Well, from Tata Motors, we are expecting a mixed bag this time around. Why so? Because on a year-on-year basis, definitely there is a volume push, especially from the JLR division. But on the margin figure, we are expecting some bit of a contraction on the consolidated basis as well as for their JLR EBIT margins as well. If we talk about the numbers then, and firstly on the revenue figure, 1,15,440 crores is what we are expecting on the top line. EBITDA expected at 14,740 crores, while the margins could see some bit of a contraction contraction from 13.3% in Q1 of FY24. This time the number is expected at 12.8%, and that we'll also highlight that because of the product mix, the margin contraction could be there for Tata Motors. If we talk about the profit figure, then 5,486 crores is what we are expecting. Indeed, on a YY basis, that will be a substantial jump. But let's talk about the India business. So India business was also seen to be quite mixed because the commercial vehicle volumes, though they were up 6%, the passenger vehicle volumes were quite stagnant. And because of the mix, we are expecting that on a quarter-on-quarter as well as on a YY basis, there could be some bit of a contraction in their individual margins as well. Now, important to watch is indeed the JLR margins, because for the JLR EBIT margins, the company has been outperforming the street expectations for last so many quarters, and this time let me tell you what the street is expecting. So number is expected at 7.9%, but sequentially that could actually be a contraction of 130 basis points, and that could be on the back of unfavorable product mix, rise in spend, as well as some bit of a contraction in their revenue figure as well. So that's the estimate from Tata Motors. We'll definitely watch out for the management commentary on the guidance and the outlook. But apart from that, any more details on the upcoming Tata Curve launch on 7th of August, it will also be keenly watched out for.
All right, thanks Rishi for that update coming in. But with that, we're completely out of time on this edition of Market Cafe on ET Now. From me, Shreyanshi Singh, Snehi Shah, as well as the entire team that put this show together, thank you so much for tuning in. But you don't go anywhere, because the market takes all of the action forward.